Welcome to The Explainer. Today, we're going to try and get inside the head of a legend. We're asking a huge question. How would Warren Buffett himself handle the wild, turbulent market of 2026?
Okay, so picture this. It's 2026. For anyone with money in the market, it feels like we're sailing into a perfect storm. We've got stocks that look seriously overvalued, a complete frenzy around anything AI, and an economy that's, well, it's looking a little shaky.
So you gotta wonder, right? In the middle of all this chaos, what's the move for one of the greatest investors in history? Especially with his successor waiting in the wings at Berkshire Hathaway. Let's dig into the core ideas that make Buffett's playbook as relevant as ever.
All right, first things first. We have to talk about the elephant in the room, this incredible AI boom, and what Buffett really thinks about all the hype.
I mean, it's pretty obvious to anyone watching that the market's recent gains have been, well, kind of lopsided. Ever since this bull market kicked off, just a tiny handful of tech giants, the Magnificent Seven, they've been responsible for a whopping 75% of the S&P 500's entire growth. But here's the thing, and this comes straight from Buffett himself. The big problem with all this hype, he says AI is so new, so in its infancy, that nobody really has a clue how it's all going to shake out. He basically says that investing in it now is just a guess.
And you know what's crazy? It's like we've seen this movie before. Back in the late 90s, all you had to do was slap a .com on your company's name and watch the stock go to the moon. Fast forward to today, and it feels like the same thing is happening with any company that even mentions AI.
And this right here, this quote from the last tech bubble, is pure classic Buffett. He argued then, and he'd argue now, that it doesn't matter how world-changing a technology is. What matters is finding a company with a real, lasting competitive advantage, that famous moat that can protect it for years to come.
So all this speculation, this excitement, it's pushed the market into some pretty scary territory. Right now, the S&P 500's price-to-earnings ratio, which is just a fancy way of saying how much people are willing to pay for a company's profits, is sitting around 40. The historical average, it's about 17. The only other time we saw numbers like this was right before the dot-com bust.
So here's the real kicker. While all the giant, famous companies look super expensive, the rest of the market is telling a totally different story. If you look at the Russell 2000, which is full of smaller companies, its performance has been way flatter. That hints that there might still be some deals out there if you're willing to look past the headlines.
Okay, so that all leads us perfectly into Buffett's current game plan, which, honestly, can be summed up by one gigantic, jaw-dropping number. $377 billion. That's the record-breaking mountain of cash that Berkshire Hathaway is sitting on. And just to give you some scale here, only 5 years ago, that pile was less than half that size, at about $142 billion.
So naturally, when you see the Oracle of Omaha hoarding that much cash, it gets everyone whispering the same question. Does he see a huge crash coming?
But here's the twist. The answer isn't that he has a crystal ball. It's not a prediction. It's just discipline. It all comes from his core strategy. 1, he's selling when things get expensive, like when he trimmed his Apple stake after its valuation shot up. 2, he just doesn't see many good deals out there right now. And 3, he's patient. He's happy to wait for the perfect pit.
All right, so let's bring this all home. What does any of this mean for you, for the regular investor just trying to figure out what to do in 2026?
Well, first off, Buffett has never been one to sugarcoat things. He's always said a really nasty market downturn isn't a matter of if, but when. He even warned we'll see something so intense it'll feel like a hair curler compared to anything in the past. But here's the key. Instead of a reason to panic, he sees that moment as the ultimate opportunity. His rules for getting through it are simple. Leave your emotions out of it. Look at big drops in the market as a sale, a chance to buy. Always remember his #1 rule. Don't lose money. And finally, you have to adapt to how the world is changing, because it's certainly not going to adapt to you.
And really, this all boils down to the very heart of his entire strategy, what you could call the perfect pitch philosophy. It's not about being busy all the time. The real money is made by being disciplined enough to wait, sometimes for years, for that one obvious no-brainer opportunity, and then swinging for the fences.
Which leaves us with one final thought to chew on. In today's world, where everyone feels like they have to be doing something all the time, could it be that the most powerful move you can make, the ultimate financial superpower, is simply learning how to sit still and wait?